Fed hiked rates for the 11th time since it began tightening its cycle, the tightening cycle 16 months ago, left the door open to more hikes, but it's not a given. Our next guest said that this should be the last rate hike of the cycle. For more on that and the implications for the bond markets, we want to bring in Kelsey, Berro, fixed income portfolio manager at JPMorgan Asset Management. And you really think this is it? This is the last hike? Nothing the rest of the year?
We do think this is the last rate hike. So when I listened to Chair Powell's press conference, I had three main takeaways. One, they view policy as it currently stands as already restrictive. How do they know that? They look at the real policy rate adjusted for inflation. That's moving up. As inflation continues to decline, the real policy rate continues to rise. That makes policy even more constrictive. Second, credit conditions are tight and getting tighter. So one thing Chair Powell has right now that we don't is the senior loan officer survey for this quarter. He said that he saw within that survey that credit conditions are tight and getting tighter. That's consistent with what we've been seeing. The New York Fed, they do a survey of credit access. They showed last month that auto loan rejections were the highest on record. That's going back to 2013. So credit conditions tight, getting tighter. What's the third thing that I took away? Forward guidance is dead, or let's just say playing dead. Right now, the Fed doesn't want to give us any forward guidance. They want us to look at the data, same as them. Initial claims this morning, GDP this morning, ECI, PCE tomorrow. They want us to look at the data and assess, just like they are, do we need more hikes? Our assessment is they're going to look at that data, and when it comes to September, they're going to see that growth is continuing to moderate. The labor market imbalances between demand and supply are evening out, and inflation, most importantly inflation, is coming down.
But Powell was also pretty clear yesterday that 2%, there's no wiggle room. They want to get back to 2%, and we could be a long way from 2%.
Yes, we are still somewhat far away from 2%, but I think...
Inflation, I should say.
Yes, exactly. But at the same time, we have made a lot of progress. We were at 9% last summer on headline CPI. We're now down to 3%. And when we go through the categories, food, energy, goods, shelter, and then services outside shelter, and we look at those leading indicators, they're really all pointing to further disinflation at this point.
So is the bond market right, though? Because the bond market is calling for cuts. Either later this year or early next year is the expectation on that. That's even if the Fed stands pat, that's a long way from rate cuts.
Right. So the Fed isn't ready to talk about rate cuts, but we can look back at history and what they normally do. And what happens is when they start cutting, they're generally fairly aggressive. So you look back at the last 6 rate hiking cycles. On average, the Fed cut 200 basis points in the first 12 months.
If we are going to be aggressively cutting rates, it's because there's a problem. The economy has gone into a deep recession. There's some other credit crunch or other banking financial issue that's come into play. You think that's what's going to happen?
That, or the labor market weakens more materially. And I think that's why it's very important to be watching the trends in the labor market, watching the layoff data, watching initial claims. Right now, what we've seen is this very gentle slope downward in job growth. We were at 500,000, 400,000, 300,000. Now we're closer to 200,000 on job growth. That's still above the break-even rate. So that's still putting downward pressure on unemployment. But then we look at the trends underneath the surface, things like hours worked. Hours worked has been declining now for a number of months. Typically, you don't see this large a decline in hours worked unless we're going into a more material downturn.
So go ahead.
No, I was just going to say, I was looking up your background. Number one, you're so good at this, but I just couldn't help but wondering, what caused you to get so good at this, at such a I don't know, it's a weird thing to be really in love with, following these nuances of the Fed. What prompted that?
Well, I mean, for me, listening to the press conference is kind of like a Super Bowl. It's fun.
I love that. I love that.
So my question was going to be, so we have a huge economy, huge, but the IRA and the infrastructure, percentage-wise, it's not that big a deal, but it will cause a lot of people to get hired and a lot of projects to be started, and it'll keep that part of the labor sector. You know, you're going to be able to demand better wages. There's strikes. We're seeing it right now. You're going to be able to ask for more money. It seems like is that big enough to cause the labor market to stay tight? That's what Kaplan said the other day from the Dallas Fed. That there's a lot, and this is going to be 2 or 3 years.
Right.
Spending.
So 2 points. One is that this effect is going to be spread out over time. It's not like one big shock like you had with just handing out a stimulus check and everyone going and spending. This is going to be a slow burn. But I think more importantly, capital deepening is not inflationary. So what they're doing by investing is going to help our productivity.
Down the road.
Down the road. So I think that, the difference between, the strength in business investment is the difference and the impact it has on inflation.
Yeah.
So rather than, these fiscal impulses we had during the pandemic, which were very inflationary, the IRA and the CHIPS Act, those are going to be, net positive for growth, but not necessarily inflationary, which is good news for the Fed.